My name is Sinclair Fleming, CEO of P3 Paper Plastic Products. Every Wednesday, I answer real business questions that come in through WhatsApp from operators, founders, executives dealing with real decisions. No theory, no motivation, just actually how this works in real business life. If you're building, scaling, trying to avoid expensive mistakes, this series is for you. Now let's get into today's questions. What employers wish employees knew about firing? One of the things that we think employees have a misconception on is employers or small business owners or large corporations like to fire persons, like they find a reason to pick on you or fire you. And I'm here to tell you it's the exact opposite. Recruitment and finding people and retraining and fitting them in culturally and these different things is way more expensive than keeping you and retraining you. When someone gets fired, it means that there's absolutely no hope. There's no hope for the culture. There's no hope for whatever KPIs they were supposed to hit. There's no hope for any type of integration in a different department. This person is just bad for the company. And the thing is, another thing that employers wish employees understood, that half of the time is not even your skill or your training, it's the attitude. A lot of the times people just don't fit with the culture, or they don't want to do a certain thing a certain way, or they've been at the company so long that they think that they could do whatever they feel like doing, however they feel like doing it. Or if they are supervisor and they decide to make everyone else's life a living hell in the office because they have some type of tangible power. So if it's one thing I've heard the most, hanging out with other CEOs ahead of me, my peers below, is that they really don't want to fire people, not because they're scared, but because they invested a lot of time training you, recruiting you, assimilating you to the culture. You know the products, you know the customers, you know the flow of things. There's a cadence between everyone. So employers really don't like to fire people. They would like them to be around forever. And yeah, another thing employers wish employees knew is also in regard to salary. A lot of times people accept job offers and it's either at the price point where they want it to be or a little below. And that's okay. The employers actually want you to have a stable life. Like, we don't want you to have home problems or money problems, because that turns into an issue on the job. The issue is now where the disconnect comes in, is that every employee, team member, or staff wants to have more money, which is fantastic. And the employer wants to pay you more money, which is fantastic. The key is there's two different metrics happening. The employee wants to have more money because their lifestyle is more. They need a new car. They want to upgrade their apartment. They're having trouble with their family. They have 2 or 3 girlfriends, or a guy has 6 or 7 kids, and cost of living is high in the supermarket. So they want to get paid more because of their life choices and expenses. Now, from the employer side, they want to pay you more, but they can't, because every job title has a cap on what you're willing to pay for that job title. That job title can only generate a certain amount of ROI. So if you go past that, it's not something that they can do, which is why a lot of employers try to get you into higher roles. They try to train you and expose you to other positions so that eventually you could go up in role, whether it's management or in another more profitable team, where you can get paid more because you're providing more value to the company. Not because your lifestyle is more than you can afford, but because now your skills are providing more value to the company, which then you get paid more. Also, it doesn't happen overnight. Like, your employer or supervisor or whatever chain of command you're in may tell you, hey, we want to give you a raise. They might tell you that in January, and it might not happen until September, because they have to now put you in the role and see if you can succeed in said role. So a lot of the times you hear employees or team members, staff members saying, oh, well, I'm doing the work of the blah, blah, blah manager, but I'm not getting paid. They still have me down here. is because they evaluating you every quarter to see if you are a right fit for that role, or if we need to hire someone externally for said role. They can't just put you in as the person and the salary, because the company is going to lose if for some reason it doesn't work out. Now they either have to put you back in the role where you were with a smaller salary, which is never good, that employee is going to be disgruntled, or they have to fire you. Now you're losing a good team member that was great in the position they were in, and you wanted to give them more money and more responsibility, but they weren't ready for it. So it's kind of a give and take, but definitely there's a disconnect between employer and employee with communication as to they would like to give you more money, but you need to have more skills that are providing more value to the company. And employees often want more money. 98% come and ask for a raise because the kids got bigger, they want a bigger car, they move into a different apartment, they got more kids, they want to go on some type of vacation. It's always something on the consumer level of it. And even though the business really wants you to have those things, each role has a cap. So the question is, my business is growing, but my percentage calculation is going down. I think I'm doing something wrong. Let me put it to you like this. I think you're having I don't know your exact situation, but I think you're having a calculation problem. Not because your calculations are off, but because you measure in the wrong statistic. For example, you might be having a 50% profit on $1,000, which is $500. But now you've grown and now you're making $100,000, but now you're making 5% and you're worried. But that 5% is $5,000. Yeah, 5% of 100,000 is $5,000. So you actually made $4,500 more, even though your percentage is down. So the key is not to only measure your profit percentage or your growth percentage. You have to measure dollar values. What is causing you to gain more profit that you take home? Not just fancy numbers and metrics that make you look good at the bank. Also, this is why the bank asks for your full financials, because they measure growth as well. Not only are they measuring profitability, but they want to see that your company is moving in the right direction. So I don't know what exact calculations you're doing, but as your numbers get bigger, your percentages get smaller, but the dollar amount gets bigger. This is why when you take loans at the bank, you get like a 3% or a 5%. But by the time you finish paying for the loan, amortization, I can never say that word. By the time you finish paying the loan, it's almost 50% of what the value that you borrowed. Similar to money managers in stock markets and stuff, they often make 1%, but that 1% custody fee ends up to be hundreds of thousands of dollars according to the size of your portfolio. So don't think too much into the actual percentage growth. Think more of the dollar value when it comes to gross profit. Now, if you're measuring growth itself, then you can do the percentage of where you were last year to where you were this year. But most things, bottom line, net, what are you taking home? What actually feeds your family? What will propel you into the future? So the question is, what should I pay a regular secretary or cashier? So I'm assuming when you say those words, you mean an entry-level staff that doesn't know anything about anything, that just comes to work with your team as a fresh team member. It depends on what industry you're in. You have to do salary grading every year to kind of figure out the market as to what people are paying these roles, what they see themselves as. Because a lot of times what happens is you're hiring a name of a job description, but they don't see themselves as that. So for example, the thing that you want them to do, your name in is secretary, but the duties below is like an executive assistant or executive secretary or a legal secretary or whatever the case may be. So they see themselves as the other thing, and you have to now have a conversation with them to figure out what it is. But from the operator side, you have to also know what you can afford. You have to now do your budget and understand, okay, I need someone in this position, but can I afford it? At the moment, P3 needs a CEO, so I could take a vacation. But we can't afford it, right? Like what I would pay myself to do the job that I'm doing, I could never pay someone else, and they wouldn't do it as half as good as me because I have more information and power than them. So you have to know if what you're gonna pay that person is something you can even do, and then you have to research what other places are paying for a similar role, and then you have to decide if you can beat that, match that, whatever. Because bet 10 to 1 the people applying for the job have already looked around to see what this position normally pays. Does it pay minimum wage? Does it pay 20% over minimum? Does it pay I don't know, $10,000 more? Does it have some type of bonus structure? Does it have commission? Do I get some type of awesome perks by working in that place? Or sometimes people will take less money if your company is well known, so that they know if they try to get another job elsewhere, they can use that to get another job because your company is famous for whether training or fostering talent. So when people see that on their resume, they go, oh, okay, I can take a chance on this person. They have had experience in a big infrastructure where they had to fit in different scenarios. So you have to know what you offer as a company. You have to know what you're willing to do, and then you have to fix your offer to the market when you're recruiting so they understand what value they would get from it. And once you do that, you should fall at least into a range. And then you can go, if you really need this position filled really badly, you could go 20% over. Or if you have a lot of people and people are dying to work at your company, you could go 20% below. So it's really case by case with industry and the actual business. But the price normally comes last. It sounds weird, but the price normally comes last after the research, after the perks that you would have been given, after the notoriety of your company, and after the amount of interest people have working with you when you put out job descriptions. If you have a question you want covered, send it in. You can WhatsApp it to the number on the screen, or message it through iMessage, Facebook, YouTube, or wherever you're watching this. The more detailed the questions, the better. My name is Sinclair Fleming. Now, go take action. I'll see you next Wednesday.